There's a new tax deduction worth up to $10,000 that taxpayers need to know about if they've bought a new vehicle this year or plan to in the next couple of years. For tax years 2025 through 2028, taxpayers may deduct interest paid on a loan used to purchase a qualified vehicle, provided the vehicle is purchased for personal use and meets some other eligibility criteria. I'm Jackson Hewitt's Chief Tax Officer, Mark Steber, and I'd like to outline the details of this new exciting deduction. As I mentioned, the maximum annual deduction is up to $10,000. This deduction phases out taxpayers with modified adjusted gross income over $100,000 or $200,000 for married filing joint taxpayers. There are a few things you need to know if you can claim this deduction. First, a qualified vehicle is a car, a van, a minivan, SUV, pickup truck, or even motorcycle. And it needs to be a passenger vehicle with a weight of less than 14,000 pounds gross vehicle weight rating, or GVWR. The interest must be paid on a vehicle loan that began starting on or after January 1st, 2025. The buyer must be the first owner of the car, meaning the car cannot be used. The vehicle must have final assembly in the United States. And you can find this information on the information label on the car at the dealership. Or you can also check the vehicle identification number, or VIN, to see the plant where the vehicle was built. When you are working with your tax pro, don't forget you have to include the car's VIN on the tax return, and this cannot be overlooked. Otherwise, you will fail to claim this deduction. A few other things to note. First, this deduction is not for taxpayers who lease their car. It's only for cars that are for personal use, not for business or commercial use. The deduction is available for those who itemize or take the standard deduction, which is great. Any vehicle type, as long as it fits the other requirements, will count. This includes electric cars and plug-in hybrids. If a qualifying vehicle loan is later refinanced, the interest paid on the refinanced amount is generally eligible for this deduction as well. At the end of the day, this is a great new tax deduction for taxpayers who qualify. But like any life change, I do not recommend buying a new car just for the tax benefit. I wouldn't tell you to move to a new state, or get married, or start a side gig just because there's a tax break. And don't fall for everything you might see on the internet. This new deduction has very specific requirements. Do not try to claim the tax deduction if you're not certain it's for you, or you could face penalties and interest from the IRS. If you have questions and you want to know if your new car purchase might qualify for this deduction worth up to $10,000 each year, talk to a tax pro today. Schedule an appointment on jacksonhewitt.com.